Hi, Harry here for the Rant on February 7th. We continue to kind of look at what looks like, I hope, a topping process for the bull market that'll never end with 27 trillion in stimulus over 16 years. Again, folks, this is going to go down in history one day. I hope I live long enough to see it being taught that this was the craziest thing in history. Now, I want to start out with one very simple insight. The biggest mistake I see investors make in any investment or sector is the longer there's a bull market, the more sound they think it is. And of course, when there's strong fundamentals on it, that's true to some degree. But the real truth is the longer a bull market goes on, the more it gets overvalued, and no cycle, even positive cycles, 26 years of spending for a generation, whatever, no cycles don't have a top and then go down. So the truth is, the longer the bull market, the more risk there is. And of course, what's happening now? This is now, and I just take out the little, couple of weeks of COVID, okay, and a little short crash, okay? This is the longest bull market in stocks without a recession or a major, crash or correction, okay? 16 years in early March it'll be. 10 years is the longest it's ever gone before. And I've said this many times, but it's important to see that this means stocks are riskier than ever. And the riskiest they've been in this entire long boom since the early 80s, when the baby boom started driving up the economy to new heights nobody expected. And for people who remember back then, I was the lone wolf in the mid to late 80s saying, folks, this is not a rebound from the 70s downturn. This is the greatest boom in history building, get on board sort of thing, okay? So that's what we're in. But the longer the bull market, it also means there's no way to have a soft landing out of this. And we are going to see what the Fed and central banks around the world do, and governments and stuff, when things do start to crack. And I think this is the year it's going to happen. But you can't take something this big. The bigger the boom, the bigger the bust, the bigger the bubble, the bigger the burst, okay? And stocks are finally looking toppy here, okay? Now again, we need to see follow through, but stocks have been moving, led by the NASDAQ as usual, and Bitcoin and Nvidia in the AI stock. They're all starting to crack. They've been moving more sideways, okay? So what we need now is to see a more convincing breakdown. And what I'm looking at, I want to see Bitcoin, which is still my best leading indicator, break convincingly through 92,000. Okay, that's what I want to see, to say, okay, we're finally out of this. Are we just taking a correction and going up again, or are we likely have seen a top back in December, led by Bitcoin and everything else? Okay. So 92,000, and it's got to break, not just go through it and turn around. It's got to break through it, kind of, and keep going. And also here, and I've been saying this before, but it's a sign of a major top, as opposed to just a top on the way up, when you see one stock index and sector peak after the next. It's succession, because what that shows is that the smart money is starting to back out and the dumb money is piling in, and they pile into the more familiar things like the S&P 500 and the Dow, and things like that. And if they're going to buy crypto, they're just going to buy Bitcoin and so on. So we've seen this succession. The Russell 2000, the small caps peak first, and of course that's the first thing you expect. The Shanghai Composite, China, their stock market peaked also early and has been moving down more, and that is the biggest bubble in the world and should lead this downturn, and is leading it. The Chinese real estate market continues to get weaken, and boy, when that bubble's burst, I made many descriptions. 75% of the average Chinese net worth is in real estate, and they don't often have one house. They have 2 or 3 sitting empty. The other ones, it just, nothing like this has ever happened before. So we see the succession, and then emerging markets. That's the third world more. That came next, and then biotech, leading sector here, gets overvalued, goes down. And of course, the Nikkei in Japan had a second major, barely new high way back from their 1989 high. It took them all these years, okay, to get back to that. And that's as far as they're going to go, folks. And Japan's demographics are bad forever. So we're seeing the succession. Now what we should see, the last thing, the S&P 500. The DAX is the leading index and kind of, you know, S&P 500 of Europe. And of course, the ASX 200 in Australia. Australia, of the developed countries, has the best overall demographics, immigration, you know, everything, but it also has one of the biggest real estate bubbles as well. That's its Achilles heel. Now, the other thing I'm seeing here recently, which is encouraging to me, there's signs that the wage gains, you know, after the bounce after COVID, these wage gains, which was just a year ago, were expected to go up 5.3%. Well, they're backing off quick. Now the estimate ahead is 1.5, you know, and it was just 1.4 before that, but that's not much of an increase. In other words, the economy is decelerating again, and as you would expect, and of course as I expect, this COVID stimulus was a giant 11 trillion boost in the US alone, and it's showing signs of wearing off, and it should, because it's BS, okay? And you can't sustain that. So that's the most encouraging sign I'm following now, and I'm going to be talking more ahead. One of my new insights of really digging down into the 2008 and 9 downturn is that obviously TLT and the treasury bonds, especially the 10 and 30 year, and especially the 30-year treasury bond, were the best safe haven. But I've always said most of that rally, tremendous rally, up 40% plus, while everything else was crashing, came in the late stages in the last half of 2008. Well, the more I look at it, gold also was an effective safe haven in that same downturn. It just went up in the early stages more and then didn't bounce as strong in the late stages. But now I'm putting that in my models, and if you combine gold, GLD ETF, and TLT for 20-year treasury bonds, it's actually the most effective hedge for a downturn like this. And again, my best view of what's coming, knowing that governments are going to try to stop it and fight it and all this stuff, but I think that they're going to be overwhelmed by the crash, that this crash should be 1.5 times the 2008-9 crisis. And remember, that was cut short, okay, several months. That would have gone lower into 2010 and stuff, okay? But this should be 1.5 times the crash, making it more like, you know, 89% instead of 58, you know, and the length, instead of a little less than 2 years, a little less than 3 years. So that's what I'm still looking at. We still have to know, and I'm going to have to monitor this. What does the government do to fight this? How late are they? And they will be too late to respond. They already are. They see what I'm seeing coming. And how does this thing unwind? And is it as bad as it should be? The best thing for us long term is wash out this giant bubble, the biggest debt bubble, biggest financial asset bubble in history. 15 years instead of the normal, you know, 5 or 6 when you add it all up. That's what should happen, but it does look like 2025 is the year. So that's what I'm looking at. 2025, make or break year. I think we're at the end of this, just edging up because things are okay and the Fed's got our back. You can only stretch a bubble so far, and I think this is the year that it breaks. And if it doesn't break this year, I'm going to really be scratching my head. Many of you have heard me talk about John Del Vecchio, one of our trusted partners at HS Dent. He runs 2 highly successful programs, Microcap Millions and Fast Profits. He calls it FAST. Both of them are designed to help investors like you find real opportunities in today's increasingly volatile markets, and it's going to get a lot more, folks. Next Thursday, February 13th, John is rolling out a special Valentine's offer for Microcap Millions, and trust me, you'll want to hear all about it. I personally invested in this program back in October 2023, and as of today, wait for this, I am up 95%. That's not hype, that's real money and real returns. Programs that actually deliver consistent performance are rare, especially if we go into a slowdown, okay? But Johns do exactly that, up and down markets. If you want to be the first to hear about this limited opportunity, make sure you're signed up for our free newsletter at harrydent.com. That's the only way I can guarantee you'll get the details. Once again, go to harrydent.com. Don't miss this one. Stay tuned, stay informed, and always trade smart.